Hey folks, Dan Frio here with your closing bell for March 19th, 2025. So we got great information from the Fed today. They didn't cut rates, but they actually gave us projections on what they're going to do, and there's still 2 rate cuts in the cards. So that's what we're going to talk about in today's episode. So my name is Dan Frio. I do this report 2 times a day to help you guys understand real estate. Our slogan here is one application, one credit pool. We're going to shop your loan to over 30 different lenders. It's not a shtick, folks. It's actually truly what I do. So if you're intrigued on how that works, stay tuned to the end of this video so you can understand exactly what I do. So today we're talking about mortgage rates. Well, they went down a little bit, but are they going to continue to go down? Well, let's dig into what the Federal Reserve told us today and use that to give us some short-term, maybe mid-term, and some long-term ranges on where interest rates are going to go. So let's get over to the news that we have right now. The indices across the board are green. The VIX is plummeting. Look at this. It's down almost 9%. That's the anxiety level on Wall Street right over my head. But let's read the caption on the headlines. Dow closes nearly 400 points higher after Fed says 2 rate cuts are still in the cards in 2025. So now we're actually getting some context from the Federal Reserve. And that data is coming in, and the bond market's loving this as well. So you have the equity markets good. We have the bond market spiking up 19 ticks. And here's what's the hoopla is going on about right now. So if you watch this morning's video, or my attempt to try to do the live event today where we could get no audio, my whole concern was we know that they're not going to do anything with interest rates right now. They're going to wait and see how the tariffs and everything else, and they came out and basically told us this stuff. But what I want to show you right here, here's the new dot plot. Okay, this is members of the Federal Reserve. When they meet, they sit down, and this is their charting, and they're going to put dots on where they expect the federal funds rate to be by the end of 2025. Now, to put this in a context, you have to understand what the federal funds rate is, or what it is right now. So the federal funds rate right now is 4.25 to 4.5. This is basically interbank lending. That's if you're a bank and you need money from another bank, this is the rate you pay. Okay, so that's that. As that cost goes up, they pass those costs over to us, and as those costs come down, they bring down the rates sometimes for us. But here's the intriguing thing. Right now, where we are with rates is 4.25 to 4.5. So we'd be in this realm right through here, okay? Some analysts are saying, there might be a rate increases, but the majority of the respondents on here, 4.25 to 4.5, right through here. My bad. Right through here. Everybody's saying it's going to be right through here all the way through 2025. I was like, there's nobody out there that came out with rate increases. Okay, so that's where we are now. Many members expect us to be here, but the majority of the members expect us to be right down through here. That's 50 basis points, 0.5% off of rates. So they normally do increments of about 25 basis points. So this means there's 2 rate cuts in the cards. So let's get over to the markets right now. Here's the biggest piece of when you're watching the whole context of Federal Chairman Powell speaking, there's only pieces that are really intriguing because most of these questions are kind of repetitive. They're announcers trying to get, on TV and stuff like that. This is probably the biggest caption that engulfs everything that we're concerned about right now. So let's take it away over to this video right now. Let's watch actually Federal Chairman Powell speak in regards to all the questions that you and I have.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify, you were talking about how tariffs were a good part of the uptick in the inflation forecast. And I was just wondering what that specifically refers to. Is that the tariffs that have already been put in place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance sheet decision and what drove that. Did that have anything to do with expectations of how raising the debt ceiling might affect the reserve supply?
Yeah. So in the SEP, you'll see that there's not further progress on core inflation this year. We're kind of flatlining, going sideways.
Okay, I'm going to pause it right there. He was talking about core inflation. They don't really expect it to do anything. A huge piece of this puzzle came out today. And for those that watch me daily, you understand how we follow the bond market, the 10-year Treasury and everything else. What they're going to talk about right here is this is big information that I think slid under some of the radar, and it'll get brought to the forefront. The Federal Reserve is now kind of selling off a lot of their positions in treasuries and mortgage-backed securities. And you hear me every day kind of complaining there's way too much debt out there and so forth. So you have the government oversupplying the markets with bonds. And you also have the Federal Reserve flooding the market with bonds of about, I think they said $50 or $60 billion a month. And they're going to reduce that, I think, over half. That's going to reduce the amount of bonds in the market. That should help stabilize the markets and bring down the spreads between the 10-year Treasury and mortgage rates. So let's pay attention to what they're saying here. And then when you come back, I'll kind of put it in more context so you can understand it a little bit more. But pay attention when he starts saying they're going to be selling off mortgage-backed securities and government bonds and things like that, but they're going to slow down the pace.
We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already, all forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly, committee that came around to the view that we would do the same thing we'd already done, which is I guess in June, was it June? Whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer, and people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant. Although you begin to see some of the things we look at begin to react a little bit, but we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves are higher now, so you can't really see the underlying signal. So we came around to the view, and it had a lot of appeal, and so we did it. It has no implications at all for monetary policy. It has no implications at all for the ultimate size of the balance sheet. It isn't sending a signal in any hidden way that you can try to tease out. It's just not there. We're basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Fantastic news. So what we got today, we didn't get the rate cuts that we were hoping for. Well, I didn't expect that they were coming, but what we did get is the projections and now the verbiage from the Fed saying, okay, we're going to slow down our pace of selling off these bonds. That should stabilize the markets. It's going to be longer, but that's okay. At least the markets now know the direction that you're going to take. And then we get the dot plot that's basically just right here. It's telling us that there's, the majority of the members are right through here. They're saying that there's going to be 2 rate cuts. So, what you have to understand as a homeowner, though, is even though the Federal Reserve might cut rates or continue to cut rates, that doesn't mean mortgage rates are going to go down. So what we focus in on a daily basis is, what are the bond markets doing? What's the 10-year Treasury? That was why it was a great importance when he came in and said, what they're going to do with these things. So if you watch me daily, you're going to see we kind of monitor 2 bonds. So this is what this is the 10-year Treasury. I'm sorry, I always get mistakes there. This is the 10-year Treasury over here, and this is the mortgage bonds. So the spread between these two are usually about 1.5%. That's what we're hoping that they get back to. So what that means is you take the 4.2 right here rates on the 10-year Treasury. I hope you can see that. Okay. And you usually add 1.5% to that, and that would give you the mortgage rate. So that would be 1.5 to that would be 5.7. So you go over to today's rates and we got 6.7. Why is that? Well, it's because the spreads. Okay, so as the markets normalize, you might have heard bond vigilantes and things like that. The bond market's really screwed up right now. As the normalcy comes back to the markets, you're going to see, the Federal Reserve now at least come out and said, okay, here's what we're going to do, or at least anticipate what they're going to do and what they're thinking. So that was the huge news for today. So that's what we're seeing right through there in the market. So what my short-term goal, thoughts are, this is going to stabilize over the next couple of days. Then the tariff stuff, then Russia will come back in the complex and everything else. These might stay, they might not. I don't think that these are going to really plummet from here. I think they should stabilize. I'm still calling rates between 6.5 and 6.75. So they're still a little bit higher than I thought. But you can't really determine what they're going to be. But short term, I'm going to say they're going to be at around 6.75, right around that area. So if you're looking to buy a house, use those numbers to qualify. If you're looking to refinance, are you going to see 5% anytime soon? No. And I'll go back to that saying. I used to say this back in, I think, 2020 or in 2021. I said, pigs get fat, hogs get slaughtered. And what I meant at that point was a lot of people had interest rates at that time at, let's say, 5.5%, 6%. And rates at the time were like 2.5 or 3. And people were like, I want lower. And they just sat and waited. And all of a sudden, you see rates spike up and they're like, oh, geez, I missed it. It's kind of like the stock market. When do you get out? Well, you get out after it crashes. Don't do that if you're a homeowner. So look into the numbers. That's why, hopefully I'll give you my information here shortly. Let's just recap the day that we've seen. Mortgage rates eased a little bit. The stock market did fantastic. What are we going to see tomorrow? Again, it's going to be up to what's Russia going to do, what's Ukraine going to do, what's the Middle East going to do, what's tariffs going to do. So there's a lot of other things behind the scenes, folks. So looks like good news for today. What's tomorrow going to bring? Well, that's why I need you back here tomorrow. But so far, mortgage bonds did fantastic on the MBSs. So again, you saw mortgage rates ease a little bit, not as much as a lot of people thought. We got the dot plot from the Federal Reserve saying there's 2 rate cuts on the horizon. And that's it. So my information now. So don't turn the dial. You learned something today, so let me help you to the next step. So if you're out there trying to buy that first house, maybe you're trying to buy an investment property. Maybe you're like the hundreds that we get calls of each day looking to refinance. We'd love to help you. But first thing I got to do is before you call anybody to buy a house or refinance or whatever, please go to optoutprescreener.com. This isn't my website, folks. This is like the do not call list, but this is not selling your financial data. So in a nutshell, when you apply for a mortgage at any bank, when they pull your credit, your financial data is now being sold to other financial institutions. You want that to be stopped, go to optoutprescreener.com. It's a free service. It's like the do not call list. You'll subscribe and you'll be off the list. So that's what happens. So now who am I? What do I do? So my name is Dan Frio. I've done this over 35 years, folks. I'd love to help you. Okay, so here's what I do. I work at a federal bank. Cool thing about that bank is I'm licensed in all 50 states as well as Puerto Rico. The even cooler thing is we're set up with 33 other lenders right now. So here's the nice thing is you put in your application here, one right up through there. We're a bank. We're a federal bank. But if I can't help you, what we're going to do is assist you with working with this other bank. And we're going to do everything for you. But basically, that's what our services are. There's no cost for that. So I have the ability to use these 30 lenders as well as my programs to offer you guys. So how do you do that? Go to therateupdate.com. A little confusing. Well, put in your application. We can get the ball rolling, or maybe just schedule a consultation call with me. I'd love to answer any questions that you have. So if you would rather call, well, you can do that as well. You can scroll down to the bottom of the screen. There's our 800 number as well as my email address. So feel free to just email me. If you have a comment, leave that down below. But if you really need a question answered or you need some help, reach out to me at dan@therateupdate.com. Please leave your comments, leave your contact information. Love to call you and answer any questions that you have. So thanks for watching, folks. God bless. I hope you learned something today. If you did, all I ask you to do is give me a thumbs up, subscribe over there so I can get my word out to more and more people so they can understand the real estate market. Thanks for watching. See you here tomorrow. Bye-bye.